Market goes up, open interest goes up. Market goes down, open interest goes down. Now, something changed. What changed was the market remained wide and violent, but still in a range for a time period up until, say, February 28th. And the open interest dove. So if the open interest has to go down when the market is going down and people are selling, that's why they're getting out. Why is the market not moving? Well, the market's not moving because the buying isn't United States based.
In a recent analysis, VinceLanci delves into the underlying factors driving the movement in gold prices, highlighting what he views as a stealth takeover of the precious metals market. Drawing insights from UBS's chief investment officer, Lanci offers a comprehensive perspective on the current dynamics influencing gold's trajectory. Despite facing several headwinds, gold continues to achieve record highs, prompting UBS to anticipate a near-term pullback followed by further rallies later in the year. UBS's chief investment officer, Haefele, maintains a positive outlook on gold for 2024, recommending it as a portfolio hedge and projecting a trend towards $2,250 per ounce. However, Haefele advises investors to await price setbacks before gaining exposure, even if these are expected to be modest and brief. Notably, gold shipments for January nearly doubled month over month, reaching 207 metric tons, with a significant portion exported to mainland China and Hong Kong. Additionally, investors' expectations of renewed ETF buying, anticipated rate cuts from the Federal Reserve, and gold's recent momentum are expected to attract further investment. Lanci's analysis suggests that while traditional factors such as speculative trading and short-term investments continue to influence gold prices, recent market behavior shifts indicate a different buying activity source. According to an article on City Index by Razakzada, following last week's substantial gains in gold prices, investors have shown restraint at the start of the week, anticipating a potential rebound in bond yields in the dollar, particularly in light of essential inflation data and a mixed jobs report. Razakzada notes that many investors who missed out on buying gold during its initial rally last month are waiting for short-term dips to enter the market, suggesting the possibility of further gains in the near future. Join us as we explore VinceLanci's insights. Stay updated by subscribing to our channel and activating notifications. Thank you.
The UBS CIO commented on gold, which is significant. Now, UBS is not a bullion bank per se, but they represent big money in Switzerland, and they do have a lot of gold interest. I mean, it's Switzerland, right? All right, so here we go. Here's an excerpt from the CIO, Chief Investment Officer. While we see potential for a pullback in gold in the near term, this does not mean the rally can't go further over the coming year. We see gold being supported by several trends, and they go into the trends. That continues in premium. The bottom line on that report is, just to give you a quick summary, the trends remain in place for gold to be constructive. Nobody knows why it's rallying right now. They don't expect the pullback to be big, and everyone looks like they're going to be buying a dip. Something that's out there. Everyone's saying that, not coincidentally. Okay, so everyone out of the pool. Yesterday's activity, well, we should take a big pause, right? So yesterday was $20 lower. What does that mean? All right, I'm going to try and give you some framework to understand what that means. And to do that, I'm going to use a chart, this chart, by created by Goldfix founder, something that we look at. This chart, the gold or yellow line, that's the price action of the market, and the lower part of it is, just pay attention to the red line for this. The red line is the open interest. You can ignore the green lines for now. So what you see there is, you see on the top, you see the market, and on the bottom, you see the COMEX open interest, not the Globe's open interest. And it's pricing GLD on the right quadrant, on the right axis. But this is gold basically. Now, in the second one, we've identified a trend, and that trend is basically a correlation. And the red arrows show you that how gold normally acts. When gold goes up, open interest goes up. When gold goes down, open interest goes down. Now, why is that? Because gold is an investor market. Investors who put money into the market, or traders, let's call them traders. Let's call most of them what they are. Traders put money into the market goes up. Traders take money out of the market goes down. So it is Direction is largely driven by investment/speculative price, which means it's relatively short-term based. These people are not taking delivery of the metal. These people are interested in making money day to day, week to week, maybe month to month at most. That's normal gold. Market goes up, open interest goes up. Market goes down, open interest goes down. Now, something changed. Goldfix subscribers learned about it early. The mainstream media is still telling you they don't get it because that's their job. Something changed, and what changed started after October, but it wasn't in October itself. What changed was the market remained wide and violent, but still in a range for a time period up until, say, February 28th. The open interest dove. If the open interest has to go down when the market is going down and people are selling, that's why they're getting out. Why is the market not moving? The market's not moving because the buying isn't United States based. The market's not moving because the buying isn't hot money based. The market's not moving because hedge funds are buying it.
Consumer prices in the United States saw a notable uptick last month, indicating that inflation remains a persistent challenge for the Federal Reserve and President Joe Biden's re-election campaign. The Labor Department reported a 0.4% price increase from January to February, surpassing the previous month's figure of 0.3%. Annual consumer prices rose by 3.2% last month, slightly above January's pace of 3.1%. Those volatile items include gas prices, which jumped 3.8% from January to February, but are still below their level a year ago. According to Vince's analysis, consumers are grappling with higher inflation, particularly driven by increased gas prices during the driving season. While certain prices may experience a decline, such as those for nail salon services, others, such as gasoline prices, are expected to continue rising. Let's get back to the interview.
Consumers continue to contend with higher inflation in February. Yes, and that inflation will continue to be persistent because now we're into driving season, and driving season means higher gas prices. So while the price of your nail salon may drop, the price of your gasoline will go up. Jamie Dimon, CEO of JP Morgan, yesterday warned the bank the Fed should wait for additional clarity before cutting. Of course, more banks go under, that's good for him. But, he's actually right. Boeing's problems rippling across major U.S. airlines. Yeah, it's kind of interesting. Boeing is having a lot of problems. I don't want to be conspiratorial about it, but it's a good way to get people to stop flying, right? If you're trying to slow the economy down. Ultra-processed foods may not only affect our bodies, but our brains too. There's an article out in the Wall Street Journal talking about how ultra-processed foods are bad. They're talking us, that's all true, but they're talking us out of spending money. They're not saying save, okay? The ironic thing is once they've identified what healthy eating is, rediscovered it, low carbs, the keto diets, concepts like that. Once they do it, they call it a syndrome. They call it ultra-processed food use disorder. You're eating crappy, right? I'm not blaming you for eating crappy. I eat crappy, right? But that's because they've been shoving it in our faces for 30 years. Russia, President Putin said if U.S. troops appear in Ukraine, Russia will treat them as interventionists, and noted from a military technical point of view, Russia is ready for nuclear war. So he's saying, hey, don't think I'm not seeing this, right? The second thing I think is actually Putin said he does not trust anyone, and Russia needs signed guarantees when asked about an honest treaty with the West, consistent with what he said before. Putin also stated that Russia will deploy troops and equipment to the Finnish border after Finland enters the NATO, even though it's really just ceremonial. While he added that Sweden and Finland's entry into NATO is a meaningless step, according to RIA. All right, well, that's their press, right? It's the Cold War Iron Curtain. Ukrainian Army Chief, can't say it, Syrskyi, and Defense Minister Umerov held a phone call with U.S. Defense Secretary on weapons delivery. We need more guns. We need more bullets. Poland's PM Tusk said he talked about quickly unblocking U.S. funds for Ukraine with U.S. President Biden, and there was a confirmation that the U.S. will not hesitate to defend Poland if necessary. Those things seem like they're not related, but they're completely related geopolitically. If we don't help Ukraine, then Poland takes that as we're not going to help them if they get invaded, right? Ukraine is on Poland's border, and so, Poland doesn't have a great history with Ukraine, but, they have a much worse history with Russia, as we know. Russia and Germany were not very kind to Poland. And there you have it. If we're going to let Ukraine fall, what about us? That's what Poland's thinking, right? And Japan's looking at Taiwan going, if you're going to let Taiwan fall, what about us? And that's how the geopolitical rock rolls.
Gold has become a focal point in commodities markets, receiving top billing from J.P. Morgan Chase and Company. The precious metal recently attained a new pinnacle, reaching an all-time high of $2,195.15 per ounce on Friday. This surge has ignited conversations regarding the potential for further upward momentum in gold prices. Considering the recent surge in gold prices and the ongoing concerns surrounding inflation, how do you foresee these developments shaping investor strategies in the commodities market and the broader financial landscape in the coming months? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.